This is Terrence Andre Banks with Information Age Financial Solutions, coming to you from an article with Market Watch. Again, about mortgages and real estate. It's definitely a hot topic. Opinion: this widening crack in the mortgage market could sink U.S. home prices. Real estate is a big factor in our economy and where people define themselves as really where they put their most money to and is their biggest asset. Most times it's mostly a liability, but this article is definitely worth your attention. I'm going to dive right in. As always, I put a link inside the description. Opinion: this widening crack in the mortgage market could sink U.S. home prices. Redefaults on already modified mortgages are a threat to homeowners. I love the way they did this picture of it collapsing. Wall Street and news media have paid considerable attention to U.S. home mortgage modifications, but not much notice has been given to the growing problem of redefaults on these modifications. Redefaults are a massive problem and endanger the U.S. mortgage and housing markets. What is a mortgage modification? In the midst of the housing collapse more than a decade ago, mortgage modifications were rolled out to enable millions of delinquent homeowners to avoid having their home foreclosed on. In its latest report, the nonprofit Hope Now Consortium, the major source for modification data, estimated that 8.7 million permanent mortgage modifications have been implemented in the United States since the end of 2007. A modification created permanent changes to the original mortgage by one or more of the following. A. It stretched out the amortization period. B. Reducing the interest rate. C. Adding delinquent interest arrears to the outstanding principal known as capitalization. Or D. Reducing the amount of the principal owed. The 8.7 million permanent modifications do not include the temporary fixes that lenders have provided. According to Hope Now, roughly 17 million temporary solutions have been rolled out under what's called the other workout plans. The two most important ones are called forbearances and repayment plans. Under these plans, millions of delinquent borrowers were provided a temporary deferment or reduction of the payments due until their financial condition improved. These temporary solutions are not reported under permanent modifications. Nevertheless, owners give temporary workout solutions are considered current on the mortgage. Redefault mess. The U.S. Office of the Comptroller of the Currency, OCC, regulates national banks and publishes a quarterly mortgage metrics report. The OCC data comes from banks, which are the largest servicers of residential mortgages. In its report for the first quarter of 2013, the OCC stated that these services have been modified slightly more than 3 million loans between the beginning of 2008 and the end of 2012. Of these modified mortgages, 47.3% of them were still current at the end of the first quarter of 2013. The rest were either seriously delinquent in the beginning of foreclosure proceedings, had already been foreclosed on, or were no longer in the portfolio of the servicer. In its most recent report of the first quarter of 2019, the OCC noted that 21% of the most recently modified loans have redefaulted within 6 months. More than 3 million loans guaranteed by the Federal Housing Administration, FHA, that were in Ginnie Mae pools have been modified between 2008 and 2013. A 2000 report found that they have performed badly. Roughly 57% of these modified loans have redefaulted by 2013. In July 2016, Fannie Mae released data of close to 700,000 loans modified between the beginning of 2010 and the end of 2015 to provide greater transparency of modification performance. In February 2017, Fitch Ratings published a report based on the Fannie Mae's data set entitled Risk Growing in Mortgage Loan Modifications. The authors asserted that it was reasonable to assume that the trends they found for Fannie Mae modified loans would also apply to loans modified by others. The Fitch report emphasized that the most recent Fannie Mae modification in 2015 showed the fastest redefaults rate since 2010. The analysts showed this was due to the steadily rising percentage of modifications between 2010 and 2015, which were second and third modifications. Good gosh. In 2011, 95% of all these modifications originated were first modifications. By comparison, more than 1/3 of the modifications in 2015 were second or third modifications. So even if they second or third modifications, these individuals, no matter what, cannot continue to be holding these properties. This graph in the Fitch report shows that clearly the redefault rates climb as delinquent borrowers enter second or third modifications. Good gosh. This deteriorating situation with Fannie Mae redefaults has been confirmed in the Federal Housing Financial Administration's FHFA latest foreclosure prevention report. It revealed that in the fourth quarter of 2017, 54% of the loans modified 12 months earlier were current and performing. Until 2008, 2018, Fannie Mae published redefault rates for its modified loan in its quarter of credit support. The table below shows the consistent rise in these rates. So after 6 months, 18%, 21%, 14, 26%, 28% of these people are still defaulting again, 29%. After 12 months, 24%, 27%, 33%, 36%, 37%. This is from Fannie Mae. They got the source form. This is crazy. In early 2018, these redefault statistics disappeared from Fannie Mae's credit supplement, which was renamed Financial Supplement. Fannie Mae did report in its annual 10-K report for 2018 that the 12-month redefault rate had climbed to 39%. Based on Fitch Ratings data, the redefault rate of Fannie Mae loans modified 3 or more years ago could be approaching 50%. What about the too big to fail banks? JP Morgan Chase holds the second largest residential mortgage portfolio in the nation. In its earnings report for the second quarter of 2019, the banking giant showed nearly $10 billion of modified loans, known as troubled debt restructurings. Of these, 43% were listed as having redefaulted. Bank of America, 2.01%, stated that 41% of its modified loans had redefaulted. Redefault rates for the worst of the non-agency bubble era loans. As I explained in a recent column, the worst of the bubble era loans are found in non-agency securitized tranches. According to the Securities Industry and Financial Markets Association, roughly $819 billion of these bubble era loans are still outstanding. A black box logic study published in 2016 analyzed nearly 200,000 subprime loans, which had been modified as late as 2013. It reported that 44% of these loans had defaulted within a year and 60% within 2 years. For many years, TCW has been publishing a monthly mortgage market monitor using data from CoreLogic's loan performance database. The September 2008 report reveals that prime, Alta A-A, and subprime security mortgages were delinquent for more than 2 years before the major services modified the loan. The majority of these modifications tacked delinquent interest onto loans' outstanding principal. Forbearance and repayment plans. The 17 million other workout plans from Hope Now's latest report included 10.4 million repayment plans offered to borrowers who claim unforeseen but temporary financial distress. They were nearly always coupled with a temporary forbearance by which a lender agreed to a 3 to 12 month reduction or even suspension of the regular mortgage payment at the end of the forbearance period. The borrower was then obligated to resume paying the regular mortgage amount plus the mixed payments, including principal, interest, taxes, and insurance. These additional arrears were apportioned over an agreed upon schedule until fully repaid. It's crazy. Okay. Here's an example of the 2008 California mortgage that was modified in 2015. The original loan was $400,000. The borrower had been delinquent for several years. The interest and arrears combined with the other expenses incurred by the lender to protect its interest in the note amount to $127,766. This was taken on the outstanding principal, and the new amount owed on the modified loan came to $510,000. Jeez. Because the term of the new one was stretched out to 40 years, the new monthly payment was $2,879, was slightly less than the original payment. Since the original loan was taken out in 2008, the borrower would have been paying his mortgage for a total of 47 years when it finally matured in 2055. Do you really expect this loan to ever be paid off? The original 2008 mortgage was taken out shortly after peaking California's home prices. The value of the house dropped substantially until the prices bottomed in 2012. In 2015, the property was almost certainly still in the water, yet this borrower owed $115,000 more than he did 7 years earlier. What incentive does a homeowner have to continue paying the mortgage? Redefault rates could tell us where the housing and mortgage markets are headed. Mortgage services have instituted close to 9 million permanent modifications to help delinquent homeowners avoid foreclosure and remain in their homes. Critics of these modifications agree that they merely kick the can down the road without solving the delinquency problem. Millions of U.S. homeowners have redefaulted on their mortgage modification. Even worse, a steadily growing percentage of them have redefaulted more than once. As home prices continue to weaken, many of these redefaulters will assume that continue to pay their modified mortgage does not make much sense. I strongly suspect within a year, both lenders and servicers will face hard choices about these redefaulters. Keith Jarrell is a real estate analyst who covers U.S. housing, U.S. bubble era lending, debacle, and aftermath. Contact Mecca Keith. KeithJarrell.com. Folks, I probably skipped over a little bit because when I was trying to scroll down, I might have missed my place. This article is packed with just a ton of information, And to simplify it in simple terms, but definitely worth your time reading. The problem from 2008 was never fixed, and the people, instead of being wiped out and letting all that go to the balance sheet and just having people start over, they try to keep them in. The problem is probably with these individuals, I'm making an assumption here, but I worked in this space in the foreclosure department in a large bank where like 300, 400,000 these loans that was on their books that they didn't want to let go, and they kept doing modifications and let these people sitting there for a year. They lost their job and they found new jobs. It just wasn't enough to keep up the mortgage even when they remodified it, because we live in such a different time. And it's amazing that they keep pushing and pushing and pushing asset prices higher. And all the new people buying these properties who are not in, and people living in these homes, and they seeing the prices go up. Even if they can't refinance, because even if they refinance and try to pull out some money, it doesn't mean that they can still able to sustain. And a lot of these places are still underwater, even with the market taking such an echo bubble and rebounding back to the numbers that was closely seen since 2008. In some places it's still not as high as back in the crisis time, but most places are past that point. Folks, we are ready for another crash, and this is the everything bubble. Not aware, you get aware. Start holding some cash and just be mindful of your area. If this video has been any value to you, please subscribe, leave some comments. Until my next video, I'm out.